Well, good afternoon, everyone. Welcome to another Team Partner Live. I'm Andy Dunn, Team's Managing Director, and thank you very much for joining us. Today's session is all about the new financial playbook, avoiding the mistakes costing recruiters the most. Because a lot of businesses look profitable on paper, but behind the scenes, founders are often losing money through poor tax, extraction, and planning decisions. Really excited to be joined by Poonam Mawani, Managing Director of Azuki Accounts, and Christian Mather, Director of and Wealth Planner at One Day Wealth. Two people who are in the team network, who work together, who collaborate, and they help recruitment leaders every single day. So without further ado, Christian, Poonam, great to see you both. Can you introduce yourselves and give us a bit of an overview of this session?
Go on, Poo.
Okay. Poonam Mawani at Azuki Accounts. We do everything back office finance related to recruitment businesses. Our clients are only recruiters. We're hoping that today will give you some takeaways and some things to think about that you can implement within your own companies as well as your own personal wealth building. We're hoping that you can actually think about some things that you probably haven't thought about before.
And you, Christian?
Christian Mather, as I say, Director at One Day Wealth, specialising in working with recruitment founders and leaders. I'm a financial advisor that really cares about your outcomes and ensuring that all the hard work you put in recruitment actually leads to a better life now and in the future.
That's great. I know you're going to be sharing some slides with us today. So
we are. If Jahisha wants to share the slides, and we'll kick off there. So
the new financial playbook, great.
Yeah, exactly. So we'll start with I think it's over to you, Poonam.
Yeah. So we wanted, as we're in, well, just into February now, we wanted you to have a think of the new financial year that is approaching. And are you thinking about some things such as tax, cash flow, and personal wealth? With regards to tax, everybody often celebrates EBITDA, but actually they don't think about debtor days, timing, VAT payments, etc. And tax and cash flow really go hand in hand together. It's not just about the main business taxes, but also your personal taxes as well. So these should all be factored into personal cash flows as well as business ones. I see often a lot of people declaring dividends to pay tax, but bearing in mind that then increases your tax bill for the future and you're constantly chasing that dividend tax bill. So this is the time to start speaking to accountants about whether you're managing all of those things together and are you even keeping a track of when they are. With regards to personal wealth, there are lots of things that we'll obviously be thinking about as well. Christian, I'm sure you have some inputs for them on kind of what you think they should be looking for or planning.
Yeah, appreciate that. I think what it all comes down to is I speak to recruitment founders all the time, people leaders, and it really comes down to, is the business working for you? Is it working to do what you originally wanted it to do? You probably got, maybe if you started a business, you probably did it because you were a top biller somewhere, you thought it could be done better. Most of us start a business because, where we're working there at the moment doesn't feel right. And I think personal wealth tends to be an afterthought. The idea being that I need to be wealthy or need to be rich to be able to invest money. But like anything, it's about thinking forward and putting good habits in place now. Ultimately, big businesses, when you're an employee, they forecast with pension contributions in there. You should be thinking the same. You should be thinking about how you can use your business to build the personal wealth and give you the financial freedom that you really want in the future. And that's really why we're talking about this today, because it's so important for accountants to be matching up what you want to do with your personal wealth and your financial advisor as well. Because so often, and this is where me and Poonam work really well together, what we're seeing is a complete disconnect between the accountants and what the advice that they're giving, and ultimately how your personal wealth's growing from there as well.
The mistakes we commonly see. So no forward cash flow, something you're going to hear a lot from me on, because it's probably one of the biggest challenges that we see businesses not doing. Obviously, Azuki clients get cash flows incorporated into what we do, but I always urge people to not just do business cash flows, which we will support them on, but also personal cash flows, and forward these out and push these out to a number of months as well, because, just because you don't have a tax bill to pay in the next couple of months, that doesn't mean you don't have one in 6 to 12 months that you need to be planning for. Everyone always just thinks they should be doing things for the lowest tax possible. And yes, while that is technically correct, you want to try and minimize as much tax as possible. Sometimes there may be decisions that you make that may increase the amount of tax that you have to pay, but actually that's still the best thing for you to do. So definitely speak to your accountant about what your end goals are. I'm going to talk about whether that's, a transaction of some kind, whether it's a lifestyle business. Actually, there are lots of different strategies, but it depends on what your ultimate goals are. But you should be speaking to your accountant about whether it is the right thing to just go for the lowest tax possible, or whether actually paying some additional tax and taking out more money from the business in the short term may actually achieve your goals. Being reactive, we talk about reactive, proactive a lot in this webinar, but it really is important for you to be reactive and think about not just be reactive, but proactive in kind of what you're hoping to achieve. Actually planning things and not just being on the back foot, and being able to manage cash flow is really, really important. So don't just wait for the tax bill to come and then decide what to do with it. You should really be kind of planning these things in advance. And no wealth building. This is definitely Christian's domain here, and he's an expert in this field. But actually making sure that your business goals align with your personal ones too.
Pona, interestingly on this, and it's a conversation we often have, when you tend to take over an account from someone, become someone's accountant, what are the common problems that you're seeing, when you're taking over those accounts?
Often when we're taking over from non-recruitment accountants, there are lots of challenges that we face in, often it's missed allowable expenses, and allowing that, and we have a crib sheet on what we use, and we give that to all of our new clients right from the start, so they're aware of what things that they can put through the business to reduce tax. Also, basic accounting concepts followed, like accruals, prepayments, smoothing out. If you pay rent quarterly, making sure it's smoothed out in your P&L rather than just lumpy quarterly. But this means that actually you have an accurate set of figures to make business decisions on. And if you don't have those accurate numbers, how can you make decisions based on the end goal and, extracting profits in a tax efficient way? And, the first thing to do is make sure, I need to know if I'm putting my name on something, are these numbers correct? So it's really, really important to have accurate numbers.
Again, it's something that I often see is there's a bit of an assumption that your accountant gives you your end of year accounts and just sign them off, but actually it's your responsibility, isn't it?
Absolutely. You need to know what those numbers mean. We always have meetings with our clients to go through what those accounts mean for them, what they can do differently to, improve things, what they have to do for the next year. And while, we talk about this later, but, these numbers are old. Usually you have 9 months to prepare a set of statutory accounts from your year end date. So actually, if you're waiting a few months, they're already out of date, but you should be having accurate management accounts to base those numbers on. And if you don't understand what things mean, speak to your accountant. They should be explaining it. They should be talking through what's happened, what it shows, what it all means.
Okay, fantastic. And look, I suppose from my perspective, when we talk about mistakes and what professionals should be doing to us, and one of the biggest things good professionals do is help you avoid making mistakes. And I think that's the big thing is we work with hundreds of clients. We've made mistakes ourselves. We've seen clients make mistakes, and actually ensuring you don't make costly mistakes. And that can be being a low tax thinker. Ultimately you're trying to sort of manage the tax you're paying in 1 year, but by not extracting money out of the business or not doing something that's proactive, you can actually be growing your own wealth now rather than leaving lots of retained profit in the business. So there really has to be a play-off about this, and to be able to look forward rather than backwards. And I think from my perspective, often in finance, we're very good looking at backwards, but the past's already happened. We actually need to sort of think, what do we need to do now to make sure that we're successful into the future as well? Again, just a quick anecdote. My niece, she's not actually in recruitment, but she's in contracting. She came to me 6 months ago and said, I'm going into contracting. I want an accountant. And I put her on to someone. She didn't use that person, and she was here in my living room at the weekend moaning because she said, the accountant's not talked to me about how to take my salary and dividend, and whether I'm paying my full NI this year, and all these sort of things that we should be doing. Should be taking my pension out. Again, it's about being reactive. The accountant's filling her accounts, but he's not advising her on how the best money, what the best way to extract that money out is. So it's very much, if you've got someone in place already, go and ask them the questions. And if you're not getting the answers you want, don't be afraid to find the answers somewhere else.
Absolutely. And that's why networks like the team are great, right? Because you actually have all of those specialist advisors at your fingertips.
And you've got other people in recruitment that can make referrals and say, speak to these people, or can tell you what their experience is on it as well.
Yeah, peer leverage. It's amazing.
Exactly. So look, just quickly, I'm going to ask people to use the comments if they were, help guide us into giving you the best information. But where do your pressures usually come from? Is it tax? Understanding what you need to pay, when you need to pay it, how you need to pay it? Is it cash flow? Understanding how you can improve that and what you can do better. Is it taking the money out of the business, the extraction, or the long-term wealth building, or you just struggling with any of it? So it'd be good to hear if anyone's got any comments or anything that they'd like to put. I'm not seeing an awful lot coming on through on the comments, so if we don't get anything, we'll just crack on from there. Okay. So from the perspective of business planning not being personal planning, what we see when we're taking clients on is wealth being tied into their business. It's founder dependent, and ultimately, if you don't have a personal plan that sort of matches what your business is doing, you're not going to generate the wealth in the first place. I think recently, speaking to someone that came on as a client, she said she was 43 years old. She's been in recruitment for 20 years. And ultimately, one of the things that's happened to her is post-COVID, things went very well, making more money, lifestyle expanded somewhat. But the last couple of years have been much tougher. And ultimately, she's got a team there. They get paid first. She's been able to withdraw less, and it's made things very, very tight for her. And one of the things that she said to me really stuck with me and resonated with me, which was, if I'm still grinding like this in 10 years and I haven't got anything to show for it, it feels like I've been a failure. But she's not been a failure at all, because she's running a great business that ultimately, had some difficult times. So what we tried to talk to her about is what she should be doing. And first and foremost, that's understanding your number. What I call your freedom number, the number you need to achieve to be able to walk away from your business one day. It's understanding where you are now and understanding the habits that you need to do and having a roadmap to get there. And it's really about that joined up thinking. What do you need to extract from your business year on year? And then being able to actually go back to someone like Poonam and go, this is what I need to run my business. This is what I need to extract to live my lifestyle. And this is what I need to extract to build my wealth. Because from that point on, you can actually then go into your business and you can work backwards, because you can understand, what your average placing is, how many placings you need to make. And it can help you really push your business on to being something that drives your personal wealth and having a joined up plan across business and personal. that perspective. But yeah, is that something that you're familiar with, Purnam?
Yes, and I think one of the Mark has commented about extraction, and exactly that. One of the things that I will say is a lot of people try and keep themselves under the 100k earnings because you keep your personal allowance, and yes, that is the most tax efficient way. But actually, if you have a short-term goal, even a medium long-term goal about it being a lifestyle business, etc., then actually you might choose to take more than 100k out. Yes, you'll pay some additional tax on that, and we can do some bandings for you in terms of, you know, how much versus how much you would take in terms of and pay in tax. But actually, that may be a strategy that actually you could have a much better quality of life by just taking, say, 150 or 200 out. Typically, recruitment business owners do the basic PAYE of about 12, 13k, and then the rest as dividends. And you know, one of the challenges with that, as I mentioned earlier, is that you're constantly then paying more tax because you have to declare more dividends to pay your dividend tax, and then you're constantly chasing that dividend tax. And we've seen, particularly in the recent downturn, the past couple of years, lots of people racking up great big overdrawn directors' loan accounts where there isn't enough reserves to declare dividends. And if you don't have reserves, you can't declare the dividend. And this then causes quite a lot of hot water, people to be in hot water and a lot of challenges. And what I'll say is actually a short-term strategy might be to put yourself on a higher base salary. And maybe you need to put yourself on a 50, 60, 100k base. You know, yes, you're paying a bit more in, you know, national insurance and PAYE, but actually that might be better for you. And actually you're not then constantly chasing that dividend tax. But there are lots of different strategies and ways of doing it. One of the other solutions is, you know, potentially having an investment vehicle where you put some of your retained reserves into there. And that might be a mechanism of doing other investments. And always using your personal, pensions allowance as well, which I know Christian will talk about shortly.
Okay. Yeah, look, I'm certainly interested with regards to the retained, because this is a question that I get people coming to me on LinkedIn and asking me a lot. I've got cash in my business. What shall I do? So it's interestingly from an accountant's perspective, from my perspective. First and foremost, make sure that you have enough operating funds there, and and you forecasted out what you need. Secondly, if there is genuine cash left over, the advice is invest it. But one of the things we always look to is, if you have an operating business with a lot of cash in, you have liabilities. So what options are available for people to sort of move that away from the operating business?
I mean, you obviously have to do lots of cash flow management and working capital management as well. You definitely don't want to fall short of being able to pay your current liabilities, particularly HMRC. But on top of that, I mean, I'm a big fan of a dividend policy, and it's very clear then that it's not disguised remuneration and that you're not just paying the same amount every single month, which most people still do, but is that part of the dividend policy? It shows that you are actually distributing profits of the business rather than just using it as a tool to pay yourself. So if you ever did have an HMRC review, you know, I'm a big fan of dividend policies. But saying that, then after you've done that and after you've kept the money in the business that you need, you know, actually there are other things. You might be able to channel it into investment companies and make further investments from there. Actually, we've seen quite a few businesses invest in crypto. It might not be the right play now. It may be a year ago, a couple of years ago, it was a different matter. But there can be some quite tax efficient savings from, you know, doing investments as well.
Okay. And one of the things I do see, and I'm not a mortgage advisor by any stretch of the imagination, but I do see is where people are paying themselves a low salary and a higher dividend, then they want to go and get, you know, remortgage or get something like that. The mortgage company are then looking at what the actual salary that you're taking. Now, they will look at things like dividends and company profit, but it probably will mean that actually you'll pay more on an ongoing mortgage as well. So yeah, all these things have a knock-on effect, and that's where we come is the strategy that's needed for them. It's not just one thing, it's actually looking at what your circumstances are and having the best strategy for those circumstances.
Yeah, completely agree.
Okay. So I suppose we've looked at this, the trade-offs, and you've discussed this a little bit as well, Poonam. The lower tax now, or better options in the future, and it's certainly something I think that's highly misunderstood from my perspective. The real reason being is you've talked about it. It's it's those sort of hard markers. I actually spoke to a client last year. Their business was doing really well. EBITDA was about £300,000. They were effectively a solo recruiter, but they were only extracting £50,000 a year from the business, and actually it wasn't really covering their lifestyle from that perspective. And my question to them was, why? Well, what like, you've got the profit in the business, it's all there. Like, ultimately you've got lower overheads. Why are you doing it? It's because they were told that's the most tax efficient thing to do by their accountant. But actually, that lower tax now isn't always the right thing to do, because we can extract money from it. We can put money into an ISAs. If you're a couple, that's £40,000 a year, and then that can grow tax free until the point that you need it. Well, actually, compounded over several years, it hasn't got to grow that much to get your original sort of gross amount back. So it is really about those options in the future. As it comes to pensions as well, if we look at pensions, so I think there's a question from Mark there for you, and I just noticed. If we look at pensions, it isn't just a retirement tool. So one of the big misconceptions I get is people saying to me, I don't like pensions, I don't trust them, and it probably comes from a perspective of not understanding. What a pension is a tax deferral tool, okay? It's not a tax-free tool, it's a tax deferral tool. So you can extract money pound for pound out your business, because you're going to reduce your corporation tax. It's seen as and you'll fill this in for me, but by HMRC, it's seen as a perfectly reasonable way to take money out of your business, for certainly for an owner and employees of it. And it's really about being able to time that so you can control the corporation tax, but it's also about being able to grow assets tax-free over the long term, so that ultimately at the point you exit a business, you decide to stop work, you can then take those out when you're on a lower tax bracket. It's tax-free growth, it's tax-free entry, and there's some tax to pay on exit. So it's really about the timing now, the tax that you pay later, and the control that it gives you over that as well.
Just to answer Mark's question, technically both. But what I would say is, so for example, we've seen a shareholder of the business, instead of being a personal shareholder in their own individual name, actually the company and another company that they'd set up was the shareholder. And so all dividends were redirected to the other company. From that company, they declared dividends to themselves up to 100K to keep their personal allowance. And then with the surplus dividends that went up to that company, they're using that to invest in that company. So that company is still almost separate from the recruitment business, but can be an investment vehicle for surplus funds. The other alternative is that you do just extract more dividends from the company and then use that for investment. But I've seen lots of recruitment businesses invest in other things as well, Bitcoin and things like that. There are lots of different ways of doing it. There are pros and cons of each. I would say talk to your accountant and they will be able to advise you based on your personal goals.
Okay. Do you know something as well? I think that we haven't particularly covered off today, and it's something that comes up for me, Poonam, is alphabet shares, and understanding that. So very much in that situation, if anyone didn't see Mark's comment, he was asking if they should invest spare funds through the business or take them individual. Often, if you have got a partner, as in husband, wife, or significant other, and they're not, particularly maybe if they're not working or they're on a lower income, there's potential to make them shareholders. So I'd probably ask you to talk about the pros and cons of Alphabet shares, and maybe just tell us a little bit about them, if you would.
Yeah, I'm a big fan of Alphabet shares, and I see it really, really commonly used with spouses to use up kind of their bandings. If you have a partner that earns significantly less than you, actually can be a very tax efficient way of sharing dividends and not breaching those thresholds. If you've got one that, so that both of you stay under the 100K, and also potentially, keep the child benefits and stuff that you get as well, childcare vouchers. So they can be really, really tax efficient way. The good thing is that you could have, so class A, class ordinary B, ordinary C, etc. And you would give yourself, say, for example, category A, and you'd give your partner share B. And what they would mean is they have the same dividend rights, but they are non-voting. So you can put specific rules on the different categories of share classes. What I will say in that is, please, please, please make sure you get a shareholders agreement, because even if you think, your partner is never going to leave you or anything like that, God forbid there are fallings out and things happen, at least the business is protected with a shareholders agreement. So please make sure that that's drawn up as well. But yeah, Alphabet shares are a great way of incentivizing other people as well, other senior leaders in the business, but also, protecting the voting rights of the company.
Okay, interesting. And if you have got a partner, can they make pension contributions?
If they are shareholders, directors, yes, potentially,
yeah.
And use up allowances that way. Obviously, go into their name, into their personal pensions, but that's still beneficial for the combined couple.
And I suppose, in what instance wouldn't they be able to make them then?
I mean, it really depends on personal situations here. So I really think we need to talk to the individual, understand a lot of their other income and assets, and then we can come up with a strategy for pensions. But with pensions, it's on timing of the physical cash payment. And you can go back to prior years and use up allowances as well. So we need to make sure we see what other payments have been made, when they were made, and what the right tax advice would be for the individual.
Okay. And I suppose from my understanding, and please correct me if I'm wrong, if, let's call it husband wife, isn't working in the business, pension contributions are just pretty much out.
Yeah. I mean, you'd have to show some sort of working role, but there are ways around that.
Yeah, okay. And the question just come up from Stephen. Understand HMRC are looking into Alphabet shares more closely, i.e. spouse needs to have more than 1% in order to split dividends equally between spouse and owner, otherwise it looks like a tax loophole.
Yeah, I mean, I always would say at least 5% anyway. 5% is the qualifying limit for business asset disposal, what used to be entrepreneurs relief. So, you want to give your spouse 5% and keep that anyway. So definitely the 1% are pointless. But if you can get over 5%, it shows that actually there's a real strategy for why you're doing it. And usually they're more favourable for them.
Okay. I suppose looking back versus deciding ahead, and for me this becomes, particularly for you, Poonam, about being reactive against proactive accountants. It's probably what we're both quite passionate about in that sense as well.
Absolutely. Big ones. If you've got big personal life events coming up, we had a client who got married and had some significant cost outlay that needed to be done. Actually, if we have that context, we can come up with a strategy for you on extracting wealth in order for you to pay for that and minimize tax. Obviously, I'm not proposing you pay your wedding bills through the company, but if we know that those personal extraction needs to happen, then we can help you in what the business can afford to declare as dividends, etc.
Okay. And again, it really comes back to having a plan rather than looking back at what's already happened in the future. And I think proactivity for me is coming back really to understanding your numbers, what you need to be able to get from the business, and also being able to work with your accountant on that. So quite typically what will happen with us is We'll look at someone's personal situation. We'll look at what they want from their life. We'll look at putting some numbers around that, and then we'll look at how we can actually build that wealth in. But ultimately, where it does come unstuck quite often is then they take these numbers back to the accountant and almost get, so what? So what? Because they're an accountant that are doing compliance work rather than an accountant that are actually advising them on how to build the business and how to extract the money from it in the best way. So a lot of the work I end up doing is quasi high level guidance on, well, actually these are the things you could be doing and you could suggest to your accountant. So it's very much for me this proactive pace. And look, I'm going to give you an example. Last week I spoke to recruitment founder, doing very well in their business and niche, and it was a pretty surprising conversation. When I told Poonam about this, she just said what, because actually, she's been doing all the right things. She's been putting regular contributions into her pension. Her end of year for the business is May, and the accountant actually said you have to take all your pension contributions if you want to do a lump sum pension contribution by the end of the personal tax year on the 6th of April. Otherwise, it's tax avoidance, which I had to ring Poonam and ask her up and said, is that right? Because I'm pretty sure it's not, because ultimately it's just planning within the business and taking it out, because she felt that she didn't, until she knew what her end of year was close to and what a corporation tax was going to be and everything like that, she didn't want to make the decision. And it's actually stopped her taking money out of the business for the last few years. So one thing I did say to her is this a recruitment specific accountant? And she said no. She said, I know what you're going to tell me. I shouldn't be with this accountant. And I said, well, you've answered your own question. So it's very much about having your head around the numbers, having the right advice, and having someone that's going to tell you what's the best thing to do compliantly, and what's the plan moving forward from that perspective. How did you feel about that one, Poonam?
Yeah, I mean, it's obviously not accurate at all. I mean, timing of pensions is super important. So when you actually make physical payments, but absolutely, if we know that that's what you aim to do, then we can support that with cash flows and making sure that the business is able to support that goal. So not accurate. We love pensions. The government loves pension contributions because it's just helping them out in the future, isn't it? With an aging population. So, the more we can encourage people to pay into personal pensions, the better for you in your long-term goals. Just answer Mark's question. I would say 3 months cash, but have a dividend policy where surplus is maybe retained in the business for a bit of growth, but the remainder of it is declared as dividends and profit extraction. You should come up with both of those. So keeping a hold of minimum amount of cash in the business as well as a dividend policy. So
can I just ask, when you talk about dividend policy, is that something you'd sort of sit down with clients, discuss, and something you just like literally a written policy to say, this is what we will do when X happens?
Exactly. And it may be that you choose to keep 30% profits every single month into the business and keep it there so that you can use that for working capital growth. And we'd have to obviously look at the business to see what the working capital requirement is, and can you pay your current liabilities on time. But then after that, everything else can be declared as a dividend if you so wish. If you have multiple shareholders, it may be equal, it may be splits. If you have alphabet shares, it may be splits in the correct way. But having a policy shows HMRC that actually it is profit distribution and not disguised remuneration.
Okay, I understand. Look, again, you're probably helping me. What's the concern with disguised remuneration then?
Well, if HMRC review and they see that you're taking the same amount as a dividend every single month, irrespective of what else has happened, one of the risks is they say, well, this is just a mechanism to paying yourself a salary. And in which case it should be PAYE and you should be payrolling yourself that. And the reason why they don't want you to do why they don't want the dividends is because it's lower tax. So for them, they're like, actually, that's not the right remuneration package for you. But actually, if you just back it up with a dividend policy, they can be quite lucrative to support your purpose.
So it's effectively ensuring you're compliant and you can evidence what exactly you're taking and why.
Yes, exactly. Just to back, it's basically to cover your bum, that you've actually thought about it and it's not just tax avoidance.
So question from Becky, might be a difficult one to answer, but you might be able to give me a roundabout. My accountant is definitely not helping advise me on a lot of these things. What would you say a rough cost for a recruitment specific accountant is?
Depends on the services that they provide you, whether they're just doing year-end accounts. I mean, if you're just doing year-end accounts, it's really hard for accountants to always necessarily add value, because they're literally only seeing your numbers and speaking to you kind of once a year. A lot of our clients, most of our clients are all outsourced finance functions for them. So we speak to them daily. We do their bookkeeping for them, management accounts, credit control, for example, pay and bill. And because of that, we are an extension of their business. All of our clients receive a free quarterly strategy meeting with one of the directors. So you're in effect getting a CFO once a quarter to review your numbers, see what have you got planned, work backwards from there to achieve your goals, and then come up with strategy plans.
Okay. And look, again, maybe if someone didn't need, because I know your service and it's good for businesses of a certain size, but say someone was thinking after this conversation, hang on a minute, my accountant's not doing these things. What's the best, I wouldn't say what's the best way to look, but what are the questions should they be asking, before engaging with their accountant or a new accountant or the one they've got?
Yeah, I mean, this involves sharing quite a bit as well. And I always say, actually sharing is caring. You need to tell us what's going on in your personal life so that we can give you some advice. If we don't know lots of things, it's really hard to give the right advice for you. But definitely talk to them. They would say, how, and a lot of them won't give you all of that advice, right? Just on a pitch or a proposal. You'll need to be kind of engaged because there's PI issues with advice and with accountants. But if you were a client, you could say, right, these are the things that I'm concerned about. I want you to talk about what is the best way to extract profits from my business. This is what I have in my personal life and my personal goals. This is what I hope to achieve. And I'm hoping the business can support that. Actually, for me, it's about wealth extraction, or it might be growing the business as quickly as possible, or, I want to do an exit in the near future. All of these play different tax strategies. So, for example, if you say I want to go and do a deal in the next 3 to 4 years, I personally don't think you can have a lifestyle business and gear up to do a transaction. I think they're conflicting. Lifestyle business is trying to extract as much as you can in a tax efficient way to fund your lifestyle. Amazing. And there's no issues with that. But just be mindful that that is what your intention is. But then if you say, on the other hand, I want to grow my business and I want to sell it in the future, actually they're conflicting, because actually what we should be saying is, let's keep as much of those profits into the business and reinvest them, whether that's new headcount, new divisions, whatever it may be, in order to grow the business, acquisitions potentially. But all of those things have different goals. So just make sure you're very clear on what you're hoping to achieve yourself.
Start with the end in mind, as Stephen Covey would say. I've always got something that I would say is, build the business that works for you, but know what that business is. If you by all means, and if anyone looks at my LinkedIn content, businesses in recruitment are difficult to sell, but you can significantly increase your chances by being intentional about what business, what you want your business to do as well. So just a question from Ben, which I'll answer. I'm sure you'll have some input on that. Take 50,000 PA for a mix of PAYE and dividends, growing some of cash sitting in dormant in the business, considering putting it in a GIA platform. So effectively, what I'm assuming that means is you're looking to use the money within the business and invest it, and to keep it within that business structure, likely to return a 9% year on year. Is it a sensible investment plan, or could I put it better to use? It's difficult to say off just that information, but what I can say first and foremost is what we've been talking about here. First and foremost, is it potentially sensible to take some more money out, put some, £20,000 a year? If you're married or you've got a partner, that's £40,000 a year into an ISA that can then grow tax-free. So when you want to extract it, there's no tax to pay on it. So you're front loading the tax effectively on that, rather than, because once you grow it within the business, the growth is going to be corporation tax, and of course when you want to extract it, you're still going to have to pay tax on that. So I think you want to be very clear about the intentions of what to do, and I'd certainly seek some advice on that side of it. With regards to the GIA platform, common way to invest money through a business, returns at 9% year on year. Again, I don't know what you're investing in. From my perspective, that would sound like what you'd expect to get from equity type investments, or that. I'd just make sure that the investment strategy fits your long-term your long-term needs and goals. It's not just about the risk, it's about volatility, when you might need that cash, and everything in between. I would say, from my perspective and opinion, you are at the point where you need some kind of advice to make sure that all those things are lining up from that perspective. So don't know if you've got any comments on that, Poonan.
Yeah, and the only thing I completely agree with Christian. And the only thing I would add is you're taking 50k out of the business. I don't know if you have any other personal income, for example, rental properties or anything like that, but I would still maximize up to the 100k from the business. It's the most tax efficient way still for you. So you still got 50k there to play with for extraction in a tax efficient way. Yeah,
and my point being there is, if you want to invest, you can then put it in an ISA, which is tax-free growth and tax-free extraction. So it's just front loading the tax now from that perspective. Okay. Okay. Better extraction. Yes. Questions that we might ask, and I suppose this is around how do we start to plan and how do we start to understand?
I think we touched on quite a few of these points already, but how much stays in the company is based on like a policy, a dividend policy, or actually what your long-term goals are. So is it investing for future growth? Is it actually a lifestyle? All of those things play into part here. Cash flow modeling is crucial, particularly nowadays. In the post-COVID boom where cash was in abundance, it wasn't such a big issue, but nowadays actually businesses are running much leaner. Back in the day we would have said you actually need to keep 6 months cash reserves in the business, but with a downturn that's lasted nearly 2 years, that 6 months being prudent is not enough. But cash flow modeling, particularly around big cash outlays, corporation tax always coincides usually with a VAT quarter. Make sure that you're planning for those payments, and making sure that you're prioritizing that HMRC is being paid over dividends as well. One of the saddest things we've seen is with the downturn, people take dividends and actually the business hasn't done well, and you're only taking a basic PAYE and you haven't got enough dividends or you haven't got enough reserves to declare as dividend. A salary of 12k a year is nothing, and actually you've probably got staff that are earning considerably more than you when you are probably the most hardest working employee. So actually, is that strategy necessarily right and causing you more stress because you're not able to comfortably pay your mortgage in your life? And in which case I would say going on a PAYE base might be a short-term play while you build up the business, cut costs, whatever it may be. But speak to your accountant about it, because you shouldn't be suffering and running a business and not taking any money out either.
Yeah. Look, cash flow forecasting is something that's really important with business, but it's also something really important with personal as well. And it's something we would always do. Ultimately, we want to answer the questions a bit like Ben's question earlier: is what's the optimal strategy, taking in my circumstances into consideration? Because there's the optimal strategy on a spreadsheet, and there's also the optimal strategy, given your emotion, your business position, and everything else. So much like what you would in your business, we would run cash flow forecasting to look at future projections of where you will be. So for instance, the question from before, Ben, that would be very much like, well, what if how much tax might we pay now by extracting more money from the business? What percentage growth would we need to see to to make us in a better position overall? So it's very much about understanding now, understanding the future, and going from there as well. So I think there's a follow-up from Ben there. What's the tax percentage attributed to drawings between 50 and 100k per annum? Should I be taking extra 50k as dividends as opposed to PAYE?
I mean, PAYE, you should be at least on 12, 13k a year, so 1k at least a month, and then the rest is dividends. It's still, I mean, the last budget they closed that gap slightly more, but it's still slightly cheaper to take dividends than PAYE at the moment. So definitely bridge it with the dividend.
And I think your point being is the PAYE, you might start taking more than that 12. To be a bit more, to be plan around it a little bit more, particularly, if the business is struggling in cash flow, not doing as well as it has, and you're taking a dividend. But if actually the business is okay with cash flow, and in Ben's case, you're taking an extract, dividends are still the best policy. And I think dividend tax, top of my head, is it above 52,000? Is it 33 3/4?
Yes, the effective rate's slightly gone up now, but yes.
Yeah, it's gone up goes up from April, doesn't it? So you still got this tax year, you can take that out. So from the high level, the extra 50,000 that you're taking out is going to cost you, 15, 16, 17,000 in, so you're still getting 30,000 plus in your pocket. And I suppose Poonam would say, just make sure you're putting that money away to pay the tax bill.
Yeah, don't just take out what you need to pay for something. Actually, you are going to have a significant tax bill the following year.
Yeah, okay. So I think just to sum things up, our message is really proactive planning leads to better outcomes. If you're reactive and you look backwards, you can't change anything. You can only pay the tax bill. If you're proactive and you look forward, you can link your personal circumstances with your business circumstances. From my perspective, I always want to work with accountants, and it shows to me when clients come on board and introduce me to their accountants how open they are to sharing things and information. And one of the reasons that Poonam and I, have worked together is because we're seeing it from the same. We're singing from the same hymn sheet, I should probably say. Ultimately, I'm there to help clients plan their personal finances. Poonam's there to help them plan their business. But put together, it's more than the sum of its parts. And if you've got a team working for you, you can then focus on your BD, your staff, running your business, rather than worrying about the numbers as well. I'm being told, so again, Ben coming out, I'm being told by my accountant to only take 6,500 PA per annum as PA.
So that's the national insurance threshold. So they're doing it just to keep you under the national insurance threshold. The 12.5k is your personal allowance. I would always say go up to the 12.5. I mean, it's not particularly significant, but you're not talking a huge amount there. But I would prefer to go up to the 12.5.
Yeah, and interestingly enough, on that as well, I'm not sure, you might know this off the top of your head, but I can't quite remember where it is you want to make sure that you're paying your full national insurance stamp so that you get your rights to your state pension, which I'm not sure if you stay at the minimum, you pay the full stamp on that as well. So you won't get full qualifying years for state pension. And just to give you an idea, state pension is £12,500 a year from next April. It will still be around in time to come. Maybe it's a bit older, but in investments, that £12,500 a year, you would need somewhere in the region of £250,000 to £300,000 to give you that kind of ongoing income. So just think about that as well. You might be saving a little bit on NI now, but are you paying that full stamp as well, from my perspective? Okay. Just going to finish off this. This is my sort of I think my personal thing that I've put in there as well. I always like to say, best time to plant, it's a Chinese proverb, the best time to plant a tree was 20 years ago, the second best time is now. Ultimately, what we're saying is you act now, plan ahead, don't be looking back in a few years and saying, I wish I'd done something now about it. And then we'll finish up, and there's been plenty of questions coming, appreciate that, but if there's any questions anyone would like, or any questions Andy's got, or anyone in between, happy to answer it.
There was so much information. What's the one thing that people should do, the one minimum thing people should do from both of you after watching this session now for this quarter?
I will say get a calendar from your accountant of all taxes that need to be paid. And so we give all of our clients this calendar when they first join us, so they know when VAT, corporation tax, PAYE, personal tax payments all need to be paid, and then do a cash flow, please, please, please. Not just for the business, but for personal as well.
I'd say review the relationships that you've already got. Review your relationship with your accountant. Don't be afraid to use this to go and ask them some questions. And if you're not getting the answers that you want, go and seek advice elsewhere. You're in team, go and speak to other recruiters, not just saying us, go and speak to other recruiters, ask what their experience is, ask what their accountant's like. I think particularly with accountants, people, we get an accountant, we sort of stick to, I'm guilty of this myself. And I've said to Poonam, I've had the same accountants for 7 years and they're useless. Because I know a bit, I sort of just feed it to them and they do it all for me. And I'm like, I need to actually change accountant myself. So I think we can be very, not want to change. And it's same if you've got a financial advisor, are they just, telling you to fill your pension up, or are they actually proactively planning on what numbers you need to reach to reach success? Are they working with the other professionals? Because you're busy and you want to focus your time on recruitment. So my takeaway, very long-winded answer, Andy, but my takeaway is review the relationships you've got. Accountants, financial advisors, not team, stay with team, and all those relationships, and go and speak to people, get in team, go and meet the other recruiters, get to the regional meetings, because that's where your real information's come from.
It's a good segue into regional meetings, because you're both going to be in Coventry in 2 days' time, where I was just printing in the background the agenda and the amount of people that's going to, look how many people are going to be at that regional meeting. But good opportunity if you're in team to come along and meet Christian and Poonam in 3D this week. I'll back this up as well. And I think the questions that you've been getting fired for the last 52 minutes and 58 seconds, it just shows that there's a lot of recruiters out there that have got the wrong advice. They're with the wrong accountants. They're not specific accountants for recruitment businesses. And they're making lots and lots of mistakes, and not having an advisor, someone like Christian in your corner as well, it's costing you so much time, money, energy. And, I really say to all team members that are watching this, connect up with both these two, have a conversation with them. All their details are in the team hub. Obviously, Jahisha's kindly put their LinkedIn profiles to connect them up on here in the chat as well. But don't sit on your hands and wait for this. Like, you've got to make decisive decisions. I thought it was a fantastic session. So thank you so much, you two, for sharing all of those pearls of wisdom. And thanks everyone for watching.
Appreciate it, Andy. Look forward to seeing you Wednesday. And feel free to reach out.
Thank
See you both soon.
Cheers. Take care.